Okay, so let's get started. This is the review for your third exam. Remember that it covers chapters 8, 9, and 10, which are the last three chapters. Your final examination, of course, will be comprehensive and include all of the chapters 1 through 10. So in this particular chapter, what we have is a long discussion about cash, the control of it, but more importantly, for your purposes, we do a lot of work for the bank statement. And, and in terms of examination questions, you're going to see something in the neighborhood of 20 of the 40 questions coming out of this chapter. And largely, what I want you to do is have a good understanding of how you do the checkbook. That doesn't mean that we're going to ignore all of the internal control aspects. And I'll hit those probably a little bit harder on the final examination, but I'll go over that in great detail with you before you actually have to take that one. So let's just start out with a quick conversation about the control of cash. And the thing that we have to appreciate is that cash is the most liquid of all assets. And it's the thing that most people have too little of and want more of. And so what we have to do, and especially auditors coming in, are going to test the cash often and a lot. And we want to make sure that the cash that is showing up on the books is the same amount of cash that you actually have. So we'll do that with a series of things. One's called a proof of cash. Another is just some basic auditing steps that we would follow to make sure that the check numbers are all accounted for properly and so forth. And what we will do is we'll run some applications, auditing applications against the cash balances that you have and the general ledger that you have. And so how this kind of works is they are platform unspecific. So no matter what kind of application you're running, whether it be QuickBooks or Mat 80 or whatever it might be, any of those will be accessed through the auditing program itself. What it'll do is it'll go out and check the missing check numbers. And then any of those check numbers that are missing will be followed up on. And then it will pull out any checks over certain amounts. So if we assign that amount as $5,000, for example, it'll give us a listing of every check that is written over $5,000, and we'll investigate those individually. So those are ways that we're actually going to do it, but we also have to make sure that we have an internal control system set up sufficient to handle any problems that we might have with cash. So one of the things we're going to do is we're going to keep the record keeping for cash separated from the person who's actually doing the handling of cash. So if somebody's receiving the cash at the counter, at the service counter, we're not going to allow that person to do the record keeping. One of the things that often happens with that is that they'll take money and then it's called kiting. And what they'll do is take money and then charge somebody's account, pay an older account with it, and keep the money for themselves. So there's a lot of things that you can actually do when you start dealing with cash. So just be aware that that's something that you would really take very great care of. I know back when I was doing auditing many years ago, one of the things that we did was do a lot of bank audits. And so we would go in to the bank in force. There would probably be anywhere from 6 to 8 of us go in, and we'd walk in. We'd have the teller step away from their cash drawer. We'd count their cash drawer. Somebody else would go into the vault and count all the cash that was in the vault, all the money orders, all of the traveler's checks, and all that sort of thing. So we do a pretty thorough job to make sure that the cash is accounted for because, as I say, that is the most liquid of all assets. So it's very important. And we want to make sure that all the cash receipts that come into the company are deposited in the bank. And I know when I was CFO, I demanded that happen on a daily basis. If there was any check at all, it had to be put into the bank on that day, so that checks were not left lying around for a couple of different reasons. First of all, you don't want people to have access to them. And secondly, you make money on money. So we want to always make as much money as we can off of the idle cash that we have. And of course, I talked a little bit already about the cash disbursements. So I'm going to skip ahead here to Sarbanes-Oxley Act. And Sarbanes-Oxley requires managers and auditors of public companies to document and certify the system of internal controls. Now, this is something that we never had to do before. And so what happens is, you know, and I mean, this is, by the way, is done even outside of public companies. And you do a thing called a management letter where you have to attest to the internal controls of the company or school or whatever the case may be. It's a very expensive process, takes a lot of work to go through. Those things I'm not going to test you on the Committee of Sponsoring Organizations or COSO, but if you have an interest in ongoing or going on in your accounting careers, you certainly want to make sure that you look at all of that sort of thing. These principles of internal control, though, those are things that we will hit on your examination. Probably not as hard as we will on the final, but certainly there will be a couple of 3 questions on this. And so you can read through it. I don't need to go through these necessarily for you, but of course you have to maintain adequate records. You have to bond key employees, and the way that that works is a bonding company will ensure these key employees and make sure that basically what they're saying is they're insuring them, so that if I were as CFO were to run off with $1 million or whatever, there's a bonding company that is taking care of that in the background, kind of like an insurance company. And of course, in order for you to be bonded, you have to have a clean record and all that sort of thing. We're going to apply these technological controls, and we've talked about that. A lot of these are now part and parcel of the auditing programs that we use when we come in and do audits on a company. And we're going to perform these regular and independent reviews. And of course, all CPAs are by nature independent CPAs. That's part of the requirement. So even if you know somebody in a company or whatever, you're supposed to remain independent even in spite of that. Okay, let's see. I'm going to skip over some of this. Part of this is because I've only got 40 minutes here to do this, but and just make sure that you kind of go through each one of these. And this is a key one here, to separate record keeping from the custody of assets. And that doesn't really matter whether you're talking about cash or some other asset. We always want to keep the record keeping separate. A lot of stuff that we do in the instance of physical assets is that we would tag them sometimes. So if I have a computer, and I have never looked at these at APAC, but I'm sure that they have somewhere on them an asset tag so that they can be identified. And you can't remove the tags. So if somebody stole one of them or whatever, they're probably protected in a couple of 3 different ways, but one of the ways is probably through some sort of a LoJack system. And then secondly, they would have the inventory tag on them and make it very difficult for somebody to pass those off. So, and we do that in a regular company as well. We want to make sure that we have as much control and protection of those physical assets as we can. Again, here's a internal control, technological controls like cash registers. And so what a cash register does, of course, is every time you ring up a cell, it records it. And at the end of every day, what you do is you run a thing called a Z total. We'll get into that a little bit more when we get over into the cash over and short area. But you'll have a Z total at the end of every day. And you have to account for all that cash. So essentially what happens is you start out with a fund, a change fund, so that you can make change for your customers, and could be $200. And so before you start work, you would take that cash register drawer and you would count to make sure that you have $200, because you're going to be held responsible for cash over and short. So you're going to make sure you start out with the right amount. And so you're going to count the $200. And then all day long, you're going to record sales using your cash register. And at the end of the day, you will do a Z total. And that will tell you how much you should have in terms of cash and credit card receipts and all those sorts of things. You will then go to your cash register drawer, remove it, and take out $200 and set it aside. And then you're going to compare the amount that you have for cash, credit card, debit card sales, those sorts of things, with the amount that you're supposed to have according to the cash register and Z total. And so what you're then going to do, if you have anything that doesn't tie out, then you're going to have to go through and do a cash over and short entry. Every day you're going to do an entry anyway. So just for example, let's just make it simple. We collected $1,000 in cash. And after I counted out my change fund, I had $1,000 in the drawer. So it would debit cash and I would credit sales. Now, if I had $995, that's something different. I would debit cash for $995. I would debit cash over and short. In this case, it's treated as an expense because you're short by $5. And so you debit the cash over and short account for $5 and you credit then sales for $1,000. Same token, let's say you came up $1,005 after you counted out your cash. Well, what that means is that you're over by $5. So you would debit cash for $105. You will credit cash over and short because now it becomes an other income, and income goes up on the right hand side, and you would credit sales for the $1,000, and that's the way that entry would look. A couple of other things, of course, we have time clocks that record hourly wages for hourly time for employees who work on that system. We have personal scanners that limit access to authorized individuals. You know, one of the ways that we do some of that is if here at ABEC, for example, I have a tag, or I have a card, and that card is an electronic card. So if I want to get into a building that I'm entitled to get into, then I press that card against a reader, and it opens the door for me. Now, it would not open doors that I'm not authorized to go into. It only opens doors that I would be authorized to enter. Okay, again, we talked about internal controls from by performing regular and independent reviews, and a lot of companies will have internal auditors, by the way. And internal auditors are kind of interesting folks because they don't report to the accounting person. So in other words, they wouldn't report the CFO. And they actually, in a public company, they don't report to the president either. And the reason is that they have to be able to go directly to the board of directors. So if you were to look at an organizational chart, you'd see the internal auditor coming off of the board of directors, because the president could be engaged in some sort of illegal activity as well. Um, most most companies do get audited. Even smaller companies like to have some control, so they will hire independent auditors to do that. Public companies must have an an external audit done by independent auditors. Okay, here's some instances of technology fraud and internal control issues. We want to make sure that if we are able to do this correctly, that we should see an increase, other things equal, and then in e-commerce. We want to make sure that we are looking at separation of duties that prevents fraud. Okay. We want to reduce some processing errors, because reduced processing errors reduce our expenses and also reduces our customer service problems. And we would, of course, do a lot of extensive testing of records to make sure that we are fairly presenting the financial statements. Now, here's one that you should probably be aware of, because you probably could see this again. Human error are limitations of internal control. So sometimes we get confused about what we need to do. That happens, with employees, especially when you're cross-training them, or somebody is new to a job. They may be confused about how they're supposed to do the job, and so they make a mistake. Sometimes people just are careless. So those are kind of things that we can usually deal with fairly simply, but the others here, human fraud, this is when you're intentionally defeating internal controls for personal gain. And one of the very interesting ones that I saw on the fraud side was a group of people who were employees of a doctor. And so there were 3 of them, and they had different job titles, but essentially what they did is they colluded. That is, they got together and they made a decision about what they were going to do. So in this case, I think they were going out for free lunches on the boss, and taking it out of the cash drawer, and then covering up for one another to do it where they weren't going to get caught. And it was very, very difficult, I would suspect, in that particular instance to catch it. It's more difficult when you have collusion, but that's why you try to separate the duties. And as you'll learn in your human resource classes, you also don't want people necessarily to be all that terribly friendly in your accounting department. You want to have a little bit of friction. You'll see some of that when you go into human resources, I'm sure. Okay, so the fraud, there's a triple threat opportunity. You have to have the opportunity to take it. You can't do it if you don't have the opportunity. So I always tell people that when, as an auditor, the first people that I looked at were the people who had access. If you didn't have access to cash, I didn't worry about you too much. And then you have financial pressure. And lastly, rationalization. And rationalization usually occurs when somebody thinks they should be paid more than they're actually receiving, which is what all of us believe. That we all believe that we're worth more than we actually get paid. So it's pretty easy sometimes to say, well, I can take this because it's owed to me anyway. And then you have, financial pressures that come to bear on people, and it pushes them sometimes into trying to commit fraud. The cost benefit principle, you'll hear this over and over again, whether it's in accounting or any other business class. What we try to do with cost benefits, make sure that the benefits that we're accruing from any kind of thing that we do exceed the costs. Now, the costs of internal controls must not exceed their benefits. I mean, that's what we say. However, it's also true that we have to be careful, because in some instances, the government decrees that we will do something in a certain way, and that's even if the cost of it is more than we would receive a benefit for. Okay, cash, by definition, it's currency, coins, and deposits in bank accounts. Could include customers' checks, cashier checks, certified checks, money orders, traveler's checks, those kinds of things. Cash equivalents are short-term, highly liquid investments, readily convertible to a known cash account or cash amount. What you typically see with this, with the big corporations, is any cash that they have that they're not using on that particular day, they're going to reinvest. And sometimes they reinvest it in a T-bill. It's just a 2 or 3 day T-bill, or sometimes just an overnight instrument. But they're always going to make some money on any cash. So in other words, they don't wind up with any idle cash. And in a lot of instances, what you see is the payments, even though we're making the payment directly in our subsidiary, say in our smaller company versus the headquarters company, the headquarters company will put the amount out there to cover all of the expenditures on that day, so that they're not leaving a lot of excess cash out there. And they'll leave a little bit of excess cash because they want to make sure they don't overdraft, but just in case there's something that pops up that they did not expect. But generally those amounts are going to be fairly small. We do the same thing, by the way, with payroll. With payroll, after the entire payroll is calculated, what we're going to do is we're going to put all of the payroll, the exact amount of payroll that is going to be used on that pay period. And that payroll amount will go into the bank or into the individual banks of all of the employees, and but no more. So theoretically, at the end of the day, assuming that everybody has a direct deposit account, at the end of the day, there's nothing left in that payroll account. It's all been used up. Okay. And again, for the same reason, we don't want to leave any excess cash there, no matter what its purpose. Okay, let's see here. I talked to you already about cash over and short, and this first one here is an example of they had $555 in the register. They were supposed to have $550, so they had $5 over. Notice it's on the credit side here. The sales remain the same, $550. And I always do talk to students about the idea of which is worse, cash over or cash short. And the reality is that they're both equally bad. Now, that doesn't necessarily mean that your employer will treat them as equally bad, but if you think about it, a business is not in the business of cheating its customers nor overpaying them, that is, cheating themselves. So either one is bad. And if you have over and short over and over and over again, unless you're talking about, now a lot of times people will say give you an extra 2 pennies if you're 2 pennies short, or instead of giving you back 98 cents, maybe they just pick 2 cents out of the container there and put it in the drawer or whatever. And then a lot of times we'll throw those pennies in there just to cover somebody else in the same situation. Notice that when you look at a shortage, okay, it's going to be on the debit side. And the reason it's on the debit side is because cash short is essentially an other expense, while cash over is another income. But again, the reason we treat them as other income and other expense is because it's not our normal purpose to be either short or over. So they're not part of our normal business operations. Okay, let's talk about petty cash again, because we need to talk about that. It's something that every company has a small petty cash fund, just the nature of it. Small payments for items such as shipping fees, maybe low-cost supplies. The ones that you normally see are maybe entertainment expense when the boss comes in and he needs to take out $30 or $20 or whatever the case may be for lunch, entertaining a client, that kind of thing. And so the way that it works very quickly here is we'll establish that petty cash fund by debiting petty cash for whatever the amount is and crediting cash. And then we'll go down to the bank and we'll take the check down to the bank and we'll endorse it on the back and then tell them how much we need of each denomination. So maybe we need 220s and 310s, whatever the case may be. Okay. And then as you pay it out, you'll get a chit for each one of those payments. And so at the end of the day, you'll have a certain amount of cash. Let's call it, you say you had a $200 fund to start with. So now 3 weeks down or 4 weeks down the stream, you count your cash and you see that you've only got $30 left in petty cash, and you should have $170 worth of expense chits. And then you make a journal entry for that, write a check for cash, go down to the bank, endorse the check, get your denomination of whatever you want, come back and replenish the petty cash fund. Notice that each time that you're replenishing it, what you're doing is you're debiting all of your expenses and crediting cash. You're not going to impact petty cash again unless you change the size of the fund. So if you had a $200 fund, decided that it was too large, then you can credit petty cash and debit cash by putting it back in the bank. Otherwise, you're going to leave petty cash alone. You're only going to treat it when you set the fund up and when you close it out. Okay, and here's an example of that initial petty cash setup. Here's an example of how we take care of all of the payments that we paid out of it. And here's how we reimburse the fund. There's all your expenses. In this case, we had some merchandise that we bought somehow or another. They went down to the hardware store, whatever the case may be, and bought something, delivery expense, office supplies, stamps, and those sorts of things. And here's cash when we went down to the bank, took a check down for cash, and got $71.30 worth of actual cash that we came back and put in the petty cash fund. Because now we have noticed in this case, there's no cash over and short. They've accounted for every dollar that they actually spent out of the fund. Okay, this talks about, again, how you would increase or decrease the fund if you had a fund that was too small and you were having to replenish it too often, or too large and you weren't replenishing it often enough. You don't want a whole lot of excess cash lying around simply because it is it's an invitation for somebody to steal money. Okay. All right. Here's some basic bank services: deposits, tickets, bank statements, electronic funds transfer. You see more and more of that coming in through your direct deposit account, sometimes going out if you are having funds withdrawn automatically to pay a bill, say your car payment or whatever the case may be. And check signature cards. Everybody has to have a signature on file so that when you write a check, theoretically it is compared with the signature card. Now, does that happen? No, probably not very often, but when you have a signature card on file, if somebody suspects any kind of nefarious activity, then they would go to the signature card. So let's just say a large check was written, and it's unusually large for this particular customer, then you might go to the signature cards, because at the end of the day, the bank's going to be responsible for that. Okay. All right. This is what a deposit ticket looks like. I'm not going to dwell on this, but you're going to put your currency, coin, checks, and all that sort of thing, and then come up with a net deposit. Here on the back side, this is where the checks are listed. This is what a check looks like. I think that there is matter of fact, I know there's a question on, who the people are on a check. And of course, there are three of them. There's the maker, in this case, Video Buster Company. They're the ones that made the check, who's going to be paid to. Okay, the payer is coming out of First National bank. That's where they have their banking account. Okay, so here's the bank statement. And the bank statement, and I would encourage you to go out and take a look. There are plenty out there. There are plenty of videos out on how a bank statement works. Just go to YouTube, type in bank statement video, and you'll get 100 of them probably. And there's some that are fairly interesting. You know, a couple of young guys that I think one of them's from Australia. He used a little bit different terminology, but basically he's doing exactly the same thing. And this is what it looks like, your checks and debits. Okay, other debits, meaning, now here's where it does get confusing for students. When we think about our own checking account, okay, we debit cash to increase it. Okay, the bank is just the opposite. Let me say that again. The bank is just the opposite. For the bank, our checking account is a liability. Once we put our money in there, the bank has an obligation to back that up. That's a liability for them. So therefore, when they debit, as they did in this $23 debit memo here on October the 12th, that means it's coming out of your account. When they're crediting it, that means that they're putting it in your account. So in this case, there was an electronic funds transfer of $100. Here was a $485 credit memo. Could have been for a lot of different reasons, but if you look down at the bottom, there's a legend of how all of those things are covered. Now, I can tell you that you're going to see probably 10 questions on reconciliations. So take a look at a couple of videos. I may even have some out there, and see and make sure that you understand how these reconciliations work. Okay, so I'm going to get rid of this one. And okay, and I'm going to share another screen, which would be chapter 9. Okay, now let's talk just a little bit about accounting for receivables. There are 11 questions on your examination on receivables, accounting for receivables. They're not too difficult, except when we get into the income statement method and the balance sheet method. Now, if you go out to my YouTube channel, there is I think, a fairly good video on accounting for receivables, whether they be on the income statement method or the balance sheet method. It's handled differently. And in a nutshell, what I'm talking about here is that if you have, and by the way, we have only about 8 minutes left here, so I'm going to hurry this up. If you're accounting for it on the balance sheet method, you got to think about what the balance sheet is. It's for a single day, one day, okay? So whatever we come up with that belongs in when we do our entry to account for these receivables, whatever we come up with, that's going to be the balance in the allowance for doubtful accounts, because the allowance for doubtful accounts is a balance sheet account. It's a contra asset. That means it goes against the asset. I'm thinking almost that I need to do another one of these just so that we can walk through some of this. Again, when you're doing the income statement method, whatever the entry is, that's what it is, okay? Because in that entry, what we're doing is computing the expense. And so anytime we compute these, whether it be balance sheet method or income statement method, you're going to have a debit to the bad debt expense and a credit to the allowance for uncollectible accounts. Now, the allowance for uncollectible accounts, again, is a contra asset. That means it has a normal credit balance. So when we start looking at how we handle those entries, if we have a debit balance to start with, or we have a credit balance to start with, at the end of the day, you have to come up with whatever amount you calculated for the allowance for doubtful accounts. But just make it real simple here. I'll just do one right quick. Let's just say that you calculated that the allowance for doubtful accounts, the contra asset, should have $40,000 in it. That means that when all is said and done, that allowance is going to have $40,000 in it. So that means that you're going to have to adjust the entry if you have a debit balance in the account to start with. So you start with $10,000 debit. Okay, that means that you had more losses in accounts receivable than you had intended to have from your previous year. So you have $10,000 on the debit side, but you have to end up with $40,000 on the credit side. So that means your entry would have to be a debit, the bad debt expense for $50,000, and a credit to the allowance for doubtful accounts for $50,000. Okay, same token, you have $10,000 on the credit side now. You have to end up with $40,000. Since we add likes and subtract unlikes, what I have to do now is I'm going to have an entry for $30,000 because 10,000 plus 30,000 equals 40,000, and that's the number that I have to come up with. On the income statement method, very quickly, if I had $10,000 and I calculated $40,000, at the end of the day in the allowance for doubtful accounts, I have $30,000 because I'm going to record the entry to the debit to the expense. Okay, in this case, debit $40,000 to bad debt expense and credit $40,000 to the allowance. So 10,000 debit, 40,000 credit yields a $30,000 balance. Again, I would encourage you to go out and look at whatever I have out there for that on my channel, or find somebody else. It doesn't matter, but you really need to take a look at that. Now, this last one, and I've got a grand total here of 4 minutes or less to let you know about this. Plan assets. Okay, here are the things that you need to understand about plan assets. These are physical assets. Physical meaning you can touch them. Okay, intangibles, natural resources, these are things that are in the ground, somehow are usually associated with the ground. So you could have timber, okay, you could have coal, oil, those kind of things. Those are natural resources. Intangibles are different. You see more and more companies have large numbers of intangibles these days. And those intangibles are usually things like trademarks. So think about things like the McDonald's trademark, okay, or the Amazon trademark, those kind of things. And those are worth a lot of money. Can you imagine how much it would be worth to have the Amazon trademark? A lot, right? Okay, so I'm not going to be able to cover this. I just don't have the time. 40 minutes is a very short period of time. But take a look, because here's some of the things that are really important. How do you get to the total cost of these things? Machinery and equipment, purchase price plus any installing, assembling, and testing. Now, that does not include any damage that you do unnecessarily. So if I build a platform for a machine and it costs me $2,000, and then I drop the machine on it and break it and have to rebuild it, that $2,000 it cost me to rebuild it, that's a regular expense. It is not part of the capitalization of that or cost of that machine. Taxes, transportation, insurance, and if you have anybody that comes in and you have to pay them to show you how to operate the thing, that kind of thing. Look at these very carefully. Know the difference between land, which is not depreciable. You don't depreciate land ever. But land improvements, parking lots, driveways, fences, walls, walks, shrubs, lighting systems, all of those things. And just think about our parking lots here at ABAC. They wear out, right? As a matter of fact, we've been, I think, spending a lot of time during this COVID crisis of refurbishing a lot of those parking lots. So land improvements, we do depreciate. Land itself, we do not. Okay, well, I'm going to have to close this out now. I don't have a choice. But I do want you to go through and make sure that you have walked through all of these very carefully, especially these things with lump sum purchases and how you segregate them and those sorts of things. So you have any questions, as always, go ahead and just contact me. Send me a question if you don't understand something. I'm happy to go through it for you. It's usually easier to do that one-on-one than it is for the whole class because it's hard to herd a lot of you cats these days. So anyway, a lot of you are working and things like that. So it's just easier this way. So that's going to have to be it. And I will see you next time.